rushing around. Good morning, ladies and gentlemen, and welcome to the meeting of the Pensions Committee at Somerset Council. I'm Simon Coles, I'm the chair of this committee. Welcome everybody to the meeting, and we have the meeting will, as always, be recorded and a copy made available, and we have several people joining us on the team. So the agenda pack for this meeting is available via the ModGov app or directly from the council website via the web link, which was sent out last week. As agendas are now viewed electronically, could I kindly request that members and officers refer to page numbers from the published agenda pack to assist with all present in finding the information. Mr. Taylor, do we have any apologies?
Yes, Chair. Apologies from Councillors Michael Dunk, David Fothergill, Mike Hewitson, who's hoping to join us online, Sarah Payne from Unison, and Paul Butler from the Police and Crime Commission.
Okay, thank you. Right. Okay, are there any declarations of interest that are not already listed? I'm not seeing anybody online. No. Okay, excellent. We'll move on. Now, the minutes of the meeting on the 7th of January, which are pages 9 to 12 in our agenda pack. Can I ask, is it your wish that I sign those minutes as a true record?
It is, Chair.
Is that a proposal, Peter? Thank you. Can I see that seconded? Thank you, Habib. Okay, well, I will sign those when you produce. Okay. Item 4 on our agenda is public question time. None listed so far. Thank you. Okay, well, before we move on, I would like to register the Pension Committee's grateful thanks to Sarah Payne, who's been a member of this committee for longer than I can remember, but not as long as Anton can remember.
Since 2004.
It's 2004.
So it actually predates the committee itself.
Yeah.
The committee started in 06, but we had an independent advisory panel before that, and she was on that from 2004.
From 2004. Okay, so I would like to record the committee's thanks to her for what is effectively almost 20 years continuous service, one form or another, and I think that's an extraordinary thing. And I would like to wish her well with everything. And I'm sure the committee would join me in thanking her. Thank you very much. So if we could pass our grateful thanks on to her, Anton, if we make sure that is recorded and gets to her. Thank you. Okay, now I will make a slight change to the agenda. We're going to start naturally with agenda item 5, but I'm going to bring agenda item 7 up to in front of item 6, because both the officers for item 5 and item 7 in our agenda have to go off to other meetings. They've been double booked. So I'm making that adjustment, and I will remind everybody when we get there.
Caroline is having trouble joining at the moment. I might start with, sorry.
Okay.
We might go straight to Rachel Lamb.
I was going to say, due to a slight technical hitch, we're going to move to Rachel Lamb. Right, Rachel. Good morning and welcome, as ever. Good morning.
Good morning. Oh, this is a little bit earlier than I was thinking.
Right.
That's all right. Okay.
You did ask to come on first.
I did. I absolutely did. Thank you. Apologies. I have a Devon committee which has clashed on the same day as a Somerset, which is the first time that's happened for me. So yes, I will be jumping into 2 today. Okay, so with Somerset Fund, you've got the normal performance report in the pack. So I'll just give you sort of an overview of the information that's in that report. So as always, we measure against the Occupational and Personal Pension Scheme disclosure of information regulations, the statutory requirements relating. And for the quarter, sorry, my computer's going a little bit slow here. So for the quarter sort of ending the 31st of March, so this report I've included two lots of figures. I've done the last quarter of the 22-23 financial year, and I've also done the full 12-month period just for information. So for the last quarter, we had 92% of the work that we managed to action in target, and also 92% for the high priority procedures. And just a little reminder, the high priority procedures are the retirements and the death survivor pensions in the main. And then for the full 12 months, for the whole financial year, overall, it was 89% of all the work was in target, and 94% of the high priority procedures were in target. So if we have a look at Appendix 1, you'll just see the information that I've just given you. So it will show the different breakdown of the areas and how we've arrived at those targets. And the first one relates to the quarter, and then underneath that we also have a chart that just shows the high priority, medium and low since April 22, so you can just see how we've done over that period as well. And then a fuller breakdown of those percentages that I gave you for the whole 12-month period follows under that.
Yeah, that last slide was on page 50 of your pack.
Thank you.
Okay. So questions.
Okay. So we have, oh, sorry, have you got a question?
Right, no, well, Peter Sieb has a question. Peter.
Thank you, Chairman. It's really just a layout issue. On page 19, we've got the Brunel LGIM passive global equity, and paragraph 1.2 underneath.
That's different report.
Sorry, I do beg your pardon.
It's a different report. We're currently on page 50. Sorry, Rachel, we interrupted you.
Okay, that's all right. So we had over the last quarter, we had 10 compliments that we received into the team. We've got some general employer updates that are included on the report, which I won't go through in point 4, which just summarises. And point 5, we've got some background papers there. So I've just included there. You should have actually received, anyone that's part of the LGPS scheme should have received this information anyway, but there's a member fact sheet that's gone out about McLeod and the remedy. So I just thought it would be useful for everyone to have access to that link, just to make sure everyone's had a look, because it's a pretty good summary and gives dates and a good overview. It's an 8-page document. I also mentioned last time about recruitment on the team, and at that point, during the quarter January to March 23, we were actually down. Oh, I've got some echo. Okay. Oh, that's better. So we were down 7 staff, 7 sort of full-time staff. So that was a big impact on the team. But I am pleased to say that since this report, I'm really happy to say that we've managed to recruit all 7 posts. So although they haven't started yet, they're starting sort of end of June, beginning of July, we have managed to fill all of our vacancies. So once we have those members of staff in place and trained on all the sort of work areas, that's going to be a massive help to the team. So that's a good improvement. Okay, so Appendix 2, just go down to Appendix 2, just do a little overview on that. Really sorry, my laptop's really super slow today. It's catching up with me. Okay, so this just shows over the financial year what the amount of sort of work that we've received in, what we've completed and what's outstanding. And the bottom chart shows obviously that some of the work that we've got outstanding we can't actually action. That's on reply due because we're waiting for information either from the employer or from the member. So certificates and things, paperwork that we need for HMRC, etc. completed. And Appendix 3 is just a rolling chart just just for information, really, that shows you that when we're looking at the period 1st of April to 31st of March for the last financial year compared to the previous financial year, we're still looking at an increase in demand. So we're still having more work to action on the team. So it's just a bit of information. So we are watching that and obviously gauging the resource and having, like I say, having this successful recruitment, because it's been very tricky since COVID. Getting the post filled is a real plus. So that's a summary. So I'm happy to take any questions.
Okay, thank you. Rachel, you say you've managed to recruit the 7 missing staff members.
Yeah.
What's your normal staff complement now it's full?
So we have when it's full, it's 71 staff members.
Sorry, so you were running 10% light?
We were, yes.
Yeah. Okay, thank you. I just want to understand the quantum of that.
Yeah.
For the pedants, is that 71 FTE or 71 employees?
71 FTE. Thank you, Anton. Yes, 71 FTE.
Okay. Committee members, any questions for Rachel? Peter?
Just an observation. I think well done is in order, because that's about a 10% increase in work. A lot of the backlog has been caught up with, and the rate seems to be, the trends are all in the right direction on the rate diagram. So thank you.
Oh, thank you. I'll pass that on to the team.
I think, echoing Peter's words, I think you've done remarkably well considering the increase and the lack of staff. I'm hoping that the new staff bed in quickly, and it becomes, we can get rid of that hump.
Absolutely.
Okay. Any other questions for Rachel, or can I let her go? I'm not seeing any other questions. Any other comments? Nope. Okay, Rachel, once again, thank you very much, and we'll see you next time. But I'm sorry.
You're welcome.
Reaching your next meeting.
Thank you. Yep, I'll catch you next time, and I'll stay for the whole meeting. Thank you.
Thank you, Rachel. Bye. Okay. Are we able to move to item 5 now?
Yes, Caroline is now with us.
Right, Caroline. Good morning and welcome. I'm glad you managed to join us.
Yeah, I don't know what happened. I was sitting in the.
When you're ready.
I was sitting.
We've lost. I think you might have just muted the phone or something, Caroline. We can't hear you. And that might be the end of it.
Okay, well, we're having a number of technical issues. We're having a number of technical issues this morning. I think we may. Are we able to get Caroline back, Steve?
Caroline, you may need to unmute your phone if you're coming in just by phone.
No.
But she's got two. She's on 2 connections at the moment.
Oh, right. Okay.
But neither seem to be working.
Caroline, we've lost you on 2. I don't know whether you can hear us. Yeah.
Try logging out and back in.
Yeah, the only suggestion we can come up with at the moment is that you log out and log back in. I think in the interim, because we need to progress, I think we will move to agenda item 6, if we may. Anton will send to you. So agenda item 6, ladies and gentlemen.
As usual, this is a long and detailed report, so I'm going to just address the combined fund, but always happy to take questions on anything. So I'm going to start on point 14 on page 38. So returns for the quarter as a whole were quite reasonable at 4.1. We slightly outperformed our benchmark for the quarter by 0.5%. And yeah, markets have been quite up and down over the last year. At the moment, what's really dominating is inflation and interest rates, how quickly inflation might peak. There's signs that it might have peaked in the US, but probably not in the UK yet. Or, no, it has peaked, but not come under control. Interest rates, similarly, are at or nearer a peak in the US, to be advised in the UK. And so as the markets sort of worry about inflation, worry about higher interest rates, or decide that we're past the worst of it, they sort of whipsaw between the two. So that's basic returns for the period. For the year, with returns in the quarter to June last year, sort of negative. The returns for the year to 31st of March were negative also still at minus 1.8%. We did do quite well versus our own benchmark in the year, outperforming that by 2.8%. Otherwise, the loss would have been considerably greater. Returns for the 3, 5, 10 years are far more like what we would sort of expect in the longer term at about 6-7% seems to be the sort of long-term average that I see. And I was just going to mention then section, where is it? Section 1410. So following the 22 valuation, there's a period where I don't show this information, as the actuary works through the numbers from the 22 valuation. You can see that from the chart that the estimated funding level has dropped a little bit, largely due to investment returns in the last year, and that sort of mix of inflation. The drop right at the end is adding in the CPI increase to pensions. I have noted there's a typo on the second bullet point. That should be at the 2022 funding valuation, not 2019. That's all I was going to sort of say in remarks. I'm quite happy to take any questions.
Okay, well, I'll start with one. As we've had a significant rise in inflation, how long do you think it will be before we get back to the 6 to 7% over 3 years? Will we achieve it in the 3-year period, or do you think that inflation will hold us back over the, let's say, until 2026?
So there's a chart on which shows our progress against the valuation assumption. So that's in 14.6, he says, just not quite seeing. Yes, on page 40. Yeah. You can see that we are considerably behind that at the moment. Yeah. My opinion, for what it's worth, because obviously predicting the forward movement of markets is fraught with difficulty, and I don't claim to be any great genius on it. I sort of feel that there is a strong chance that we sort of drift towards March 25 without any significant progress in investment returns. So it wouldn't surprise me if we make 2 or 3% over the next 2 years, but I'm not convinced that we will catch up what we've lost in this particular period. But I don't, as I say, I don't claim to be any great market guru or savant. If I was, I probably wouldn't be working as an officer for Somerset County Council.
don't work for Somerset Council.
Sorry. That county word still. So yes, I think it's probably unlikely that we will catch up to the sort of 15% that we would need over those 3 years, but who knows?
Okay, thank you. I mean,
And that is something that happens in actuarial cycles from time to time. It's not something we've never faced, and the system is sort of built to cope with it to some extent.
I mean, my concern is an ever increasing population in age that will be looking to take their pensions. I think the number grows every year. Okay, we've got a couple of questions. The first person to catch my eye was John Cook Woodman. So, John.
Yeah, mine's a relatively simple question. Our target returns figure is a net figure. Sorry, Simon. Can you hear me now? Yeah, our target figure is a net return figure. I just wondered, sort of, what is the relationship, if you like, the administration fee and what would be the return on our investments? What sort of performance do we get on investments if it wasn't for the expense of getting that? What's our net? What's our gross return, and sort of what's our running thing?
So the figures I report in here are net of investment fees and costs, but not of the overall administration and costs of the fund. So when it says an absolute 4.6, as I say, that's net of investment costs. Because investment costs, it depends what you include and what you don't include, because there are some explicit fees that I can look at, and someone will say that's what we paid that person, and I can tell you exactly what that number is. But then usually there is some. There's also things like bid offer spreads on trading and things like that, which are costs we incur, but you can make a estimation of them, but they're nebulous, as it were. So there is a page in the annual report and accounts. If you bear with me, I'll tell you. See if I can find last year's, because I haven't finished doing this year's yet, and give you a feel for what that is. So if you include everything, so all those implicit transaction and trading costs, fund manager fees, etc., last year, so for the 21-22 year, that came to 0.44%. So, yeah, somewhere around 0.5% would be all of that that's already in that investment returns figure. So grossing it up would add about another 0.5%. Is that?
Yeah, no, I
yeah. But then the costs of Rachel's team, my team, governance generally, and the actuaries, the auditors, things like that, are on then further costs, which are included in the actuaries' assumptions, but I don't report investment returns after them. If you really wanted to, I'm sure I could calculate a figure. Yeah.
What do our investments do to what is actually returned? That was the relationship I was looking for.
And also the figures are net of all taxes. The taxes we pay, I mean, broadly speaking, we are exempt from tax in a lot of jurisdictions, but we do pay tax in others.
Next question is from Councillor Mike Hewitson. Mike, good morning and welcome. You're online.
Good morning, Chairman. Thank you. I don't know if you can hear me okay. I'm sorry not to be with you this morning. Anton was talking a few minutes ago about investment returns being below target. I might just turn my camera off for a moment because my internet connection is not very stable. You're talking about investment returns being slightly below target potentially for the next year or so. Presumably that feeds into a higher funding requirement from Somerset Council at some point. When will that be recalculated? Is that part of the actuarial revaluation, or does that happen sooner than that?
So you're absolutely correct that all other things being equal, which is a wonderful phrase because it never happens, but all other things being equal, if investment returns are lower than the actuary has assumed, and the target I was referring to is specifically chosen to match the actuary's assumption, then there will be a funding shortfall. And ultimately, the only way to make that up is through higher employer contributions. And yes, those contributions are recalculated by the actuary every 3 years as part of the regulated valuation. It is possible to do valuations in between. We can ask the actuary to do an additional valuation. I do not believe we are currently in a position that is sufficiently extraordinary to warrant that. We'd need to be significantly further from to really make that worthwhile.
So how far are we from the next triennial revaluation, Anton?
So the last one was done as at last March. So the March 22. So the new rates based on that only kicked in 2 months ago from 1st of April. So it feels like we're very early in a cycle, but they come around. Trust me, if you're working in pensions, they seem to come around really quick. So it is 2 years, and it will be 3 years till there's an adjustment.
Okay, so as far as Somerset Council's accounting provisions for higher contributions, we're not looking at anything in the next 12 to 18 months?
No, it would, at this stage, I would say it's, you might, if you were being cautious, recognise something in the 3rd year of the MTFP. But typically, you probably, because it's sufficiently early in the cycle, there's time for something to change. So I probably wouldn't, if I was asked, I'd probably say just leave it for the moment and give it another year, and then we'll start feeding that in more accurately.
Perfect. Thank you very much.
Councillor Haverhey.
Thank you, Mr. Chairman. Item 10.1, I just lost it actually here. UK property at 4.2% is optimistic at best, I think. The market is likely to see a 10% correction according to Savills Knight Frank this year. So are we likely to sort of feed that into it? Item 9.5.
Can I take one question at a time?
Yeah,
Because
sure.
otherwise I'll
Okay.
forget them. I'm sorry. It's just easier for me. We invest in sort of 90% of that is commercial property, not residential. There is some residential in there, but it's the vast majority is commercial property. As you will see, the returns to the quarter at -4, and the returns for the year. Sorry, I've just lost my page. Of basically -11%. There has already been a significant correction in the UK commercial property market. There are signs that has more or less bottomed out now at an overall level. If you start disaggregating that into offices, retail, industrial, other, and different regions around the UK, you will get differing results. But from what I am seeing, the prices of those property funds are now relatively stable. So from a commercial property point of view, I think the vast majority of the bad news is in the price, subject to how much further the Bank of England goes. Because if the Bank of England ends up having peak rates end up at 7%, then you are going to see more pain. But I think the market's assuming 5 to 5.5%, and on that basis, I think the UK commercial property has already adjusted.
If I may, I'll go to my second question. Smaller companies tend to do better relative to benchmark than emerging market from the report I see, and the UK market performance. Is that related in any way to Brexit? I mean, I look at the UK market is, I'm putting you on the spot, but, that's not the intention. Genuinely, I want to find out, if that's the case.
So there's a number of factors with the UK market. Some of those are that the UK market's quite an odd market because it's quite concentrated in a couple of sectors. So it's very concentrated in oil, gas, and mining. And it's quite concentrated in banks as well. And so you get some odd effects to the UK market in particular. And also, it's quite sensitive to because there's quite a lot of dollar income in the UK market. It's quite sensitive to UK dollar exchange rates. It is also then impacted by the UK economy. I don't want to get too involved in a debate as to whether the UK economy has been impacted by Brexit or not. I think it probably has. To what extent, I don't know. To what extent the markets globally, global investors have just looked at the UK and gone, oh, Brexit, oh, especially last year, sort of government in a bit of a state of flux. Do we want to invest there? No, let's just walk away without really digging, possibly. Is it a long-term structural thing? I don't know. One thing I do know is that actually the UK market, if you look at it in terms of price earnings ratios, dividend yield, price to book, those sorts of metrics, the UK market is much, much cheaper than most other markets. And some of that might be due to its sectoral biases, but some of it is just because the world doesn't like it very much at the moment. And at some point in the future, that is likely to correct. When I say at some point, I quite happily put a decade time horizon on that as a possibility. But these things do tend to unwind eventually. You would usually, because smaller companies are slightly more risky, slightly less liquid, in the long term, you would expect them to outperform, but in shorter timescales, who knows? They tend to be more volatile. Emerging markets, again, on the basis that you're taking a little more volatility risk, a little more regulatory risk, and because of the greater economic growth rates of the countries in emerging markets compared to developed markets, you would expect emerging markets to outperform in the medium to long term. But again, in the benchmarks at the moment, China is quite dominant in the emerging market space, makes up 40% of the benchmark or something. And so the economics and markets of China make quite a lot of difference. And again, there's been a lot of movement with China's somewhat delayed and sort of slightly in-out approach to unlocking post-pandemic, that's still sort of working its way through the system. I mean, this is why we have relatively small parts in that, smaller companies and emerging market pots. They should outperform in the long term, but in shorter periods, they tend to give you indigestion. So we have a relatively modest exposure to them.
My last question is on the multi-asset credit over the last 2 years. I think we are 2.2% below our anticipated target. That's 9.5, for clarity. And I assume this is before the interest rate hike. It's currently just 5%. How sure are we that it will stabilize and get back to the anticipated 3.5% per annum?
So the multi-asset credit portfolio is a slight outlier in that the benchmark for that is cash, i.e. Bank of England. It's not Bank of England base rate. It's actually what's known as SONIA, which is sterling overnight interbank something rate. So that's ticking away at, currently 4%. But the actual bonds within the multi-asset credit portfolio act like other bonds. So when interest rates go up, the value goes down. So again, you've got more of a mismatch between the asset within that we're actually invested in and the benchmark there than in most of the other portfolios. So in a rising interest rate environment, I would almost say that portfolio is always going to underperform that benchmark. You've now got UK interest rates at 4.75, probably soon going to 5%. That portfolio yields 9%. So as long as there's no more capital deterioration, it will start to outperform and catch up quite rapidly. If interest rates start to fall at some point, which I probably wouldn't say is likely in the next year now, but thereafter they probably will, you'll get some capital appreciation as well. So I still think that the target set of to outperform cash by 4% over 3 to 5 years is reasonable. And although there might be a slither of time where it doesn't achieve it, because we've had the largest interest rate hiking cycle for the last, 25 years or something, 30 years. So we've had a particularly bad period for that type of asset. But generally speaking, I think the target is reasonable and its chances of meeting it in the medium term are fine. Okay.
Okay, any other questions for Anton?
Peter, was your typo somewhere in here? Noted. You'll be surprised to hear that I produced this report by taking the previous quarters and sort of writing over it. So things like that can just hang around perhaps beyond their sell-by date. I will endeavour to remember to remove it next quarter.
Okay, good. Yep. Okay, right. Well, thank you, Anton. Right, we're now going to move to item. Pardon me. We haven't got Caroline back, have we?
We haven't, and I know she had another meeting at 10:30. So on the basis we've got through that, I apologies. I mean, I'm quite happy to I'm quite happy to take questions on her, prompted by her, the report I sent round, but obviously you're taking my word for it rather than Caroline's, and I apologise. I can easily pass them on to her as well.
On that basis, I'm going to bring Peter. You have a question on Caroline's report?
Chairman, I'm just wondering if it might make more sense for her to circulate some notes to the committee for inclusion in the minutes.
Yes, I think that's a sensible idea, and I think if we have questions for her, I would be quite happy if you submit those direct to Anton, and then we can get the answers
I will email
collectively, and I'm sure the emails will arrive imminently. So we're going to take that course of action. Thank you.
Just bear with me a second.
Yeah.
I thought she needed to go to a 10:30 meeting, but I think Caroline, if you just, are you there, Caroline?
Hello, can anyone hear me?
Can now.
Oh, right. Sorry about that. I don't know what's happening here. My husband's computer isn't working either, so I think we've got a technical problem.
We've just done my report, so if you want to just make some introductory remarks and crack on, that'd be great.
Okay, well, I think some of what I would have picked up on, Anton has already to some extent. But since I wrote the report, of course, what we've seen is the Fed saying we're going to pause for a while, but we expect to push interest rates on, and rather more negative news in the UK, and the bank certainly saying rates are going to have to go up. So as Anton was saying earlier, I don't think the market is looking for much more than 5.5%, but it would certainly be likely to get spooked if it thought that was heading that way. I think, sort of looking a little further out, I'd be slightly more positive than Anton about future returns over the next couple of years, but it is quite a difficult picture. Two of the most interesting things going on, I think, are that China is underperforming what people might have hoped in terms of its recovery. The Chinese economy is held up by the fact that there's an awful lot of bad debt linked to property hanging around in the economy, which needs to be sorted out. But the Chinese middle class are rather like people in the West, in fact to a greater extent, sitting on an awful lot of cash that they've accumulated over the last few years when they weren't allowed to spend it on anything. And if that money starts to move into the economy in a bigger way, both in China and elsewhere, because consumers' balance sheets are still reasonably healthy around the world, I think that does allow for some greater optimism. The other thing that's going on in markets that's interesting is the very sharp rally we've had in Japan. Partly, I think, started by Warren Buffett saying he thought it was cheap. Japan has been cheap for many years. And over the years, there's been a fairly regular story come out saying, look how cheap Japanese stocks are, and Japanese corporate governance is improving. Because when I started investing in Japan back in the late 70s, Japanese companies made no secret of the fact that they thought their job was to run the company for the benefit of the employees, and shareholders came at the back of the queue. That has changed over the years. There's new regulations come in. But whether this is yet another false dawn rally is a question, because it's entirely, so far, led by foreign investors. I'd also, I think, comment on what Anton has said about property, that I think it's unbelievably segmented and split. You can walk down most high streets and see an awful lot of empty retail and think, how is that going to be reused, if at all? On the other hand, I was talking to somebody from one of the big law firms in the city the other day, and she said that during COVID, their lease had come to an end. They'd said, oh, well, it's going to be working from home. We don't need such a big property. And already they realised they've made a mistake because they run out of space because people are coming back 3 or 4 days. So I think it is very segmented. If you've got the right product in the right place, people are taking property, people are continuing to get their rents. I mean, I don't think in your portfolios you're seeing an awful lot of rent shortfalls. But I think making money on secondary property is going to be extremely hard unless you're a very clever specialist. So that was covering what I'd planned to comment on. Smaller companies, perhaps I should add something from my point of view. I think smaller companies in the UK are very split. Quite a lot of them actually get an awful lot of their earnings from outside the UK, just like bigger companies. Those that are purely domestic focused are having a more difficult time. And certainly whatever else Brexit has or hasn't done, it has put up an awful lot of cost on people in terms of filling in forms and paperwork and delays and having to set up fulfillment centres in the Netherlands for things that were previously exported into the UK and then re-exported. And emerging markets, I think, are still going to have, the problem with emerging markets is that China is about 40% of the emerging market index. The rest of them are very dependent on a weaker dollar if they are going to have a stronger recovery. So that's a sort of a quick whistle stop. I'm very happy to take any questions.
Okay, questions, Habib?
Thank you, Mr. Chairman. Just a quickie here. What is the right product in the high street that, from your experience, you see people are actually going back and opening up shops?
What's happening at the moment, I'm not sure one can say is a longer term trend, because if you look at most high streets, what's tending to go in is an awful lot of luxury food, luxury perfumes and things, coffee shops, things that are really more service than traditional heavy retail. Retailers come back in terms of people wanting to walk and go and look at things, much more than it was supposed to a year or so ago when it was all supposed to be online forever. I think there's an element of saying, well, some of these shops will be there for people to go and look and order online. But I don't think there's an easy answer on retail. I mean, I'm not a professional retailer. I'm afraid I don't have it.
Okay, John.
Thank you, Chairman. Yeah, we can't get a haircut online, so there's always a hairdresser. Good thing.
Indeed.
My question was, you sort of touched on a Fed pivot kind of thing. Do you think that's coming? How soon will it come? Do you think the employment figures in the US will have a bearing on that, or do you think? And do you think the sort of inflation rate's now sort of stable at 4% in the US?
I think that the Fed would like to see the inflation rate below 4%, certainly. I mean, I don't think they can stop here. But as I said in my note, unlike other central banks, they do have a mandate to keep the economy reasonably healthy and that they come under pressure if the employment rate goes ahead too fast. So I think that's why they've gone for this pause now, to say, well, what really is the situation? Is labour demand settling down? Are people perhaps going to start coming back into the workforce? I mean, have people by now spent, got close to spending their COVID savings and getting back to a point of saying, well, actually, we do need to bring in some more money. So I think they will be patient, but I don't think I think there are still further rises to come in the US. Unless there is a sudden collapse for reasons that we can't yet see.
Okay, I'm not seeing any others online or in the room. So I'd like to thank you, Caroline. I'm sorry we had the hiccups with the technology. I hope that we'll have ironed out the gremlins by the time we get to our next meeting. So
yeah.
I hope you're able to get off to your second booking of the morning.
Thank you. No, I think next time when I see a thing saying you've been told, people are told you're waiting, I might drop an email through to make sure people do know it. Anyway, all's well that ends well, I hope.
Absolutely. Thank you very much, Caroline.
Thanks. Bye.
Okay, moving on. I believe we're at item 8 now, and that's Anton again.
So yes, it's the business plan update. Struggling to work my mouse. Sorry. As mentioned by Rachel earlier, there has been some sort of movement on the cloud. Government starting to work through the various issues around that and issue consultations. In terms of most of the rest of the things in the government's in tray that we're waiting to hear from them on, the general wisdom seems to be that we could wait an awful long time. So we're waiting for confirmation on the LGPS's response to climate change disclosure, so what we need to report on. We're waiting on details on levelling up and related matters that have been announced by both the Secretary of State and the Chancellor. There are even some rumours that actually they wanted to make some announcements, but they have absolutely no idea what they actually want, and so the chances are we're not actually going to see anything. And especially when you put in the likelihood of a 2024 election at some point, I think there's quite likely that some of these issues won't be addressed until post the election. And then with some of those issues, that is disappointing. With some of the issues, I'm quite happy to wait because I'm not sure that we should be discussing them or having to do them anyway. So that's where we are with that. Any questions around sort of government initiatives?
On government initiatives, I mean, it strikes me that this is an absolute kakistocracy of the government, and we'll have to wait until the election season changes. Are there any questions? Anton? Yeah, Peter?
Chairman, it's not one around government policy, it's around the business plan. I'm just wondering if we ought to have an item in one of the future meetings to just rub our agenda up against the terms of reference and the purpose and functions of the committee, because it just feels to me as though we've got some stuff which doesn't pass through the committee in public that probably ought to be there, even if it's effectively a tick box exercise to say, yes, that's been done and the evidence is here, yes, that's been done, the evidence is here, just a reference back. I'm thinking, for example, we've got a very extensive scheme of delegation, which includes, for example, the simple matter of making sure that that various partner organisations have collected and then transferred the dues from the members in, the contributions in. That's I think that's the second item on our terms of reference for the specific duties, and I know that's delegated, so it doesn't pass into the public arena at any point to allow the members of the scheme to see it happening. And I'm just thinking it might be useful to just have an exercise to run through the duties and make sure the committee has created a public record of having discharged its duties.
I'm quite happy to do that, but I believe you probably do it without quite noticing. So that contributions, it is reported in the annual report and specifically in the report I attach with the annual report, which comes to the September meeting. So it is, most of the items I believe are there because I'm conscious of your terms of reference and trying to make sure that all the business that needs to be done by you to meet those is done, and sufficient reporting is done back. But obviously, if you don't agree with me, then somewhere there's a disconnect that we need to address to make sure that at least the reporting back is done more thoroughly.
Chairman, I know that officers have our back and are making sure we cover this ground. It's just the annual report, of course, is done retrospectively and effectively reports a previous year. As a committee, our responsibility is to control and to make sure that there's an anticipatory duty, if you see what I mean, to make sure you have the resources you need to deliver it. in order to do that, we need something more approaching a real-time assurance, although I only see this as an assurance question, because clearly it would be ridiculous to go through the detailed numbers repeatedly, but just, I think it's worthwhile having some sort of assurance that the future's as good as the past.
And I suppose the other thing then is that whilst perhaps we need a session, as you say, to talk in more depth about how in practice each of these are met, what we as officers do to ensure that contributions are collected, etc., you also have the ability to commission internal audit work, should you wish to.
From a personal point of view on that very question, whilst I have no problem about this committee requesting internal audit work, I think it's one of the functions that we have, and if we feel the need, we should use it. Having said that, I suspect that what Peter's looking for is a slightly clearer way of the committee understanding that we have done those things. It's all well and good knowing that we've done them, but if it's only us in this committee that know they're being done, there should be, I think, a clearer, so that anybody looking in from the outside can see that yes, we have done that. So I think I'm going to support Peter in this, and ask you, Anton, if we find a way of expressing that.
Well, as I say, what I think then is perhaps, if I know it sounds a long way off, but if perhaps we put something on the December committee agenda, because as I say, September, I will be bringing the annual report, which, depending on how committee want to view it, it does give you a chunk of additional information to question and interrogate. So perhaps December would be a better point in the cycle. I'm quite happy to put a specific agenda item on, so that we look at each item on the terms of reference, and how it is addressed. Some are more obvious than others.
Yes, I mean, I think that's the right sort of timescale. I'm really looking for an assurance. We clearly record outcomes. We clearly publish outcomes. What we also have a charge is there is a machine. So let's describe the machine, and demonstration that the machine's working. Here was a variance. That's how it got dealt with. That's the sort of one-off exercise to demonstrate that you still have. You're looking at capability rather than outcome. That was what I was really driving at. But thank you.
I think we can agree that will happen. Mike Hewitson, please, Mike.
Thank you, Chair. So it's just a quick question as the incoming chair of the audit committee. So I note on item 4.3 of the business plan update report that GT are planning to start their work on the 22-3 audit. Does that get reported to both pension committee and audit committee, or does it only come to audit or only come to pensions?
So the Grant Thornton's formal reporting on that audit, for reasons I've never quite fathomed, goes to audit committee. So Grant Thornton would not usually appear at pensions committee. They would appear at audit committee, and that is the formal sign off of the accounts. As noted earlier, the annual report of the fund comes to pensions committee for formal adoption and permission for me to publish. And that does include the accounts and Grant Thornton's opinions. So I would say both committees get full chance to interrogate the accounts and ask me questions. Grant Thornton would usually only appear at audit committee, but if pensions committee particularly want them, then I will do everything to arrange that.
Thank you. So circuitously it comes to both committees then. I mean, I'm very happy to look at any arrangements that pension committee would like in conjunction with audit. There's quite a lot of overlap between the membership of pensions committee and audit committee. If you wanted, for example, a joint meeting, or we wanted to look at how that might work better, then I'm very happy to do that. I think formally it will have to go through audit, but if there's anything else we can do, I'm very happy to look at it. Thanks.
Yeah, it is somewhere someone insists it's a formal requirement that it goes to audit. So that's why Grant Thornton goes to audit committee. It's not from my point of view as the officer, it's not a particularly satisfactory arrangement really, but it is what it is, and we've managed to muddle through. As I say, because the annual report contains both the accounts and considerable additional disclosure, that gives a purpose to the pensions committee, but it does give them the opportunity to ask those questions, either that have already been raised in audit, or as well as. Usually pensions committee happens before audit committee in September. I'm fairly sure it does again this year. So actually pensions committee would see it first.
Okay, Mike?
Yes, thank you, Chair.
Okay, I think it's something that we should explore. I think maybe, Mike, you and I could have a brief meeting with Anton. Yeah, to make sure that we've got that in train. Okay. Habib.
Thank you, Mr. Chairman. I totally get this. This is legislations, and the council is responsible for taking the executive decisions. But what we see, that Rome is burning. We can't drop the fiddle and go to and change our life, basically, as the saying is. What is the option B? So do we have to wait till the new government comes into place? And
so it depends what the issue is. So if it's the climate disclosures, we could just start making some disclosures and then adjust as and when the government proclaims. Other things like the government's how the government wants us to respond to levelling up, well, those are things that we might not consider if government weren't asking us to consider them. So if government don't ask, I don't think there's any need for this committee to specifically look at those issues. We would look at them in the round when we look at the investment strategy statement. But if the government comes up with a particular niche that they want us to invest in, then until they come up with that niche, we wouldn't usually consider it. So it very much depends what it is. I mean, I suppose the McLeod issue is an issue that needs sorting, and the government, that is the one that the government are going after. Fine. Most of the other things, as far as I'm concerned, the world will keep turning quite happily if the government never proclaimed. And as I say, I think if the government turned around and said, we're never going to mandate what you've got to produce on climate disclosures, then I would happily have a conversation with you, have a conversation with Brunel as to what's available, and we would come to a decision as to what we wanted to put in the public domain. I'm always slightly loath to move ahead of government on these things because inevitably you'll decide to do something that's not what government then proclaims you need to do, and you end up doing the work twice. But if that's what committee wants, then I am your servant. I will get cracking.
seeing anybody online. Anybody? Question? Item 9 on our agenda, which is the Finance and Membership Statistics Update, which is Appendix 8. Appendix A is to follow. It's pages 63 and 64 in your document pack.
So this is the usual report, and I will need to apologise because I said that the appendix was to follow, and it's still to follow. The thing with that is that because it's the end of year outturn effectively, I much prefer that it matches what we then report in the annual report and accounts.
Well, yes.
And we haven't as yet reached the stage in producing the accounts where it's fit for that discussion to come to this committee. So we will have to delay that and have that discussion in September, I'm afraid.
Okay, that will be ready for our next meeting then.
Yes, it will. Okay. I mean, we're about a week away-ish from producing a finished set of accounts. But it's always a state of flux, especially as workloads at the moment are a little heavier than perhaps we would usually anticipate with other work at this time of year.
Okay, I think I'm happy that it's coming to the September committee. I would have preferred it to have come to today, but I understand.
Yeah.
Peter.
Am I right in guessing that the process has been extended by the switch to Microsoft Dynamics as the finance system? Is that the case?
So that has no impact on the production of the accounts this year because they're still being closed on SAP, the previous take. It has a huge impact on the team's workload in other areas, and that's not helping, frankly. I mean, one of the things that's also changed there is, so the pension fund only regulatory requirement is to publish the annual report by the 1st of December, which we usually meet, although it might not be in its final form, we usually meet that by producing it and providing it to you at the September meeting, at least in draft form. The Somerset, well, no, actually in this context, it is still Somerset County Council, have a requirement to produce their accounts by the 31st of May, and the pension fund accounts are an addendum to the council's accounts. But my understanding is that Jason took a decision that we were not going to meet that deadline and we would aim for the 30th of June. And so the pension fund's in the same boat. If I had to produce a set of pension fund accounts by Tuesday lunchtime, then I and the other officers would do the time to produce them and we could do it. But at the moment, our deadline is the 30th of June to make sure we comply with what the county is planning. So we're balancing that with other work and it just gets shuffled back a bit as we just try and just balance everything and just not flog ourselves unnecessarily for a deadline that isn't there yet. So that's where we are. As I say, if we had to do it, we would produce something.
Any other questions for Anton on this? I'm not seeing anybody online. I have nobody in the room. Okay, we'll move to item 10 then, which is the review of the pension fund.
Sorry, Chair.
Liz, my apologies. I didn't see your hand.
No, sorry for looking a bit summary too. Chair, I just wanted to say that Jason Vaughan did contact me about the late publication of the many sets of accounts, because of course it's all the legacy councils as well as the county council. And I agreed that, and I asked, as did some other members, what consequences there were for late publication, and we were told no consequences from government. So it was agreed that the 30th of June was a more reasonable target date, and I believe the first of those legacy councils' statement of accounts was published yesterday, for Mendip, and the dates are, I believe, viable, reasonable for the end of this month. Thank you very much.
Okay, thank you very much for that update, Liz. It's very, very useful. Thank you.
And in the context of the pension fund, it's only in the county council's accounts that the pension fund is appended, because they are the administrating authority. So that's why I didn't mention the district's accounts.
I've got Mike Hewitson online. Mike.
Yeah, so sorry, Joe. It's just to add to what Liz just said. I think it's something like 2/3 of all authorities are not going to meet the publication deadline. So it's an industry-wide problem. Just for members' information.
Yes, thank you. And it's also should be noted, I think, that because of the formation of the new unitary council, there was always going to be quite a lot of work to get, was it 6 sets of accounts ready for an arbitrary date. So I think we know where we are, and we can see the light at the end of the tunnel. So I think the best thing to do is let the officers get on with that.
I should also note that with a couple of the districts, prior year accounts have yet to be signed off, and that's causing additional work. So I've had to request additional reports from the actuary, because the auditors want to change some numbers to reflect things that have happened post balance sheet. So there are always knock-on effects of these things as well.
Yes, inevitably. Okay, I'm not seeing any other hands up. Right, well, we will now move to agenda item 10, which is a review of the pension fund risk register. Anton.
Yes, so just to note that PF Admin 5, I think it is, has been adjusted after a discussion at the pensions board. So this is the risk that refers to staffing levels. There was just quite a long discussion at the pensions board, primarily because of the, at that time, vacancies at Peninsula Pensions. Yeah. This is the top of page 70, is the first one there, which obviously Rachel has now confirmed has been resolved, and also some issues at Brunel around the special reserve matters on the remuneration policy, which was causing Brunel problems with retention and recruitment. And so we have specifically adjusted the description of the risk to include the words retention and recruitment, as well as staff absence, because holistically, actually, yes, staff absence through sickness can be a big problem, but tends to be short term, whereas retention and recruitment are ongoing endemic issues, especially in the current labour market. And given the vacancies at Peninsula and the issues at Brunel, both of which appear to have been resolved in the short term, but it was agreed to increase the risk score as well. So that's the only change to the register since your last meeting. I'm quite happy to take questions on any part of the risk register, but I have no other specific comments to make.
Thank you, Anton. Peter.
Chairman, 2 points. Firstly, I note that there is already a degree of baking in the PS2, which is in its unmitigated state showing as a red 15, and this is the long-term risk to funds. Noting the increase in the shortfall in the funding level, the short-term increase in the short-term shortfall that's shown earlier in the report, I think we should probably review whether the post-mitigation score is a 10 at present going forwards. It just feels as though we ought to have a good look at that one. And the other thing is, throughout the risk register, we refer to Somerset County Council, which no longer exists. Sorry, no longer controls the pension fund. Can we make that correction? Thank you.
Noted on the, there's always somewhere. I refer you to comments I made some time ago about the production of reports. The amber risk, so PF-2, pension fund has insufficient available assets to meet its long-term liabilities. The key there is the word long-term. So that risk is very much about a 10, 15, 20-year time horizon, specifically because there's also PF Invet 1, which is a short-term, sort of next 6 months inability to have cash and meet our liabilities. You'll note that one is green because we have absolutely no problems in raising sufficient cash and paying our everything as due. I think that the impact of getting long-term liabilities structurally wrong is always 5. You will, I mean, we could argue this for weeks. You'd never convince me that it shouldn't be the highest risk level, because the impact of getting that wrong is that we have just completely got everything wrong then, really. The likelihood, if we do everything right over 20 years, I think the likelihood at 2 is a reasonable target, and an achievable target. The reason that we're at red is more because we haven't reviewed that as part of the valuation, 22 valuation, and reflects the fact that it was below 90%. So we're still higher than at the point where we decided that should be a red risk, a sort of likelihood 3. I suppose the other thing is that I keep threatening to organise a joint informal meeting of the committee and board to go through the risk register in considerably more detail. So at each meeting, we tend to have a discussion. We'll pick up maybe 1 risk, maybe 2, have a quick 5-minute chat about it, and then move on. Periodically, we need to have that more considered look at the risk register. That is sort of aimed to be this year. I've aimed to do some other things this year that I haven't got round to, but I still intend in the autumn to try and get a session, informal session, committee and board all together, where we go through these risks one by one in detail, re-investigate what they are, why they're on the risk register, and have a proper debate about each risk score.
Couldn't agree more. Peter.
I appreciate the point that the ability to control this is in effect a sawtooth pattern, because every 3 years you do a reset with a new plan. I'm just pointing out that we are actually in the middle of the mid period, so we have 1/4 of the ability to control, and so I think the risks do follow a flattened sawtooth. Could I also point out that the full funding over 19 years statement needs truncating because we aren't over 19 anymore, and
we're now 16.
And the target date for the review, it says review at next valuation 2022. That's why I wanted the line reviewed. Okay, thank you.
All fair points.
Thank you, Chair. The vulnerability on long-term staff and sickness retention, how is that impacting the payment of the pension benefits?
It's not. So if we start slightly unpicking that, pension payroll, it doesn't impact. So the monthly payment of benefits, it doesn't impact. And that's categorical. And actually that payroll is very, very simple, because if you think about a standard staff payroll, you've got people changing their hours, you've got travel expenses, you've got lots of things, people maybe taking unpaid leave, that change your payroll every month. With a pension payroll, you don't have any of that. They've retired, it kicks in, you start paying it. You uprate it every year for inflation until they die. And so it's very simple. It gets paid every month. It's not a problem. Inevitably, if Peninsula reach a point where they are significantly understaffed, that high priority issues like new retirees, deaths, such and such, the work associated with them gets delayed because of lack of staff. There is the possibility for it to impact. From what you'd have to ask Rachel, fortunately she's no longer with us today, but judging from the high priority cases within their reporting, that does not appear to be the case. And those are the things that they will prioritise by definition. Getting pensions paid are always the top priority. So if they fall short of resources, that is the thing they will protect as much as they physically can, to the detriment of all other work. And I'm not aware that it's been a problem.
May I just give an example? For instance, if you have a state pension that comes to an end because, I don't mean you, but if it comes to an end because somebody passes away, then they have government pension as well. And then you have a spouse or civil partner. So, it's a bit more complicated than the normal. You come to retirement age, then everything kicks in, then the rate of inflation and everything. Those are the areas that I'm actually looking at rather than just the straightforward.
Yeah, and I absolutely appreciate that. Usually the biggest delay on death would be on the family, the estate, the executor, the solicitors, whoever, informing Peninsula Pensions. Once they have the information, it's a relatively swift calculation and adjustment to get the pension altered to being paid to the spouse. The numbers are already in the system waiting effectively. So if I go online today and look up my pension, it'll tell me what my spouse's pension is after my death already. So the system has already done the calculation. They just need to physically turn one off and turn the other on and point it at the new bank account if relevant. So it is a relatively simple process, but they need to be told.
Okay, any other questions for Anton on this? Not seeing any online, not seeing any in the room. Okay, well, we're going to move on to item 11 then, and that's the policies and statements. And Anton, your chance to shine again.
And I will take these one at a time. We have 3 for your enjoyment and consideration today. The first is the funding strategy statement. It is, broadly speaking, standard practice to do the valuation and then in conjunction with the actuary redo the funding strategy statement. So you would expect it to be on a 3-year timescale and to come to committee at around this time in that cycle. So we have as Annex 1 a draft of a new funding strategy statement for your consideration. Significant work has been done to try and remove any mention of county first. There are, if anyone really wants a tracked changes version, I could probably get you one. There are a number of things that have changed. So there are various aspects of it that refer specifically to elements of the just gone valuation. And so those naturally update. But the thought process has not changed. Mm-hmm. The main thing that's actually physically changed is a suggested change to our approach to measuring the employer liability or surplus on exit from the fund. It is quite a technical matter. I'm quite happy to go through it in excruciating detail if people want me to, but I shall await a prompt via questions. So it's out of the, I think it's something like 90 pages long. On 90% of it, it's effectively a tidy up and a roll forward of the previous document. The one substantive change is, as I say, the methodology of calculating exit liability or surplus for an employer. I would propose that we deal with the funding strategy statement and take questions and etc., and then move on to the others. I will also note that the process for this is we are, under the regulations, required to consult the employers on this. So this is a draft for committee to consider. Subject to any amendments that the committee discussed today, I will then send it to the employers for their consideration, give them 8 weeks to look at it, and then I will come back to the September meeting with the results of that, and on past experience, the results of that are not likely to lead to any material changes. So I will then bring a document, probably bring a document with a request for the committee to formally adopt it.
Okay, I've got Mike Hewitson. Mike?
Thank you, Chairman. I'm just going to ask a couple of questions about inflation, if I could. So the policies in the document around future price inflation in particular. So we're talking about RPI of March 22 at 3.2%. I think I'm not quite understanding the figures here, Anton, to an extent. So RPI was much higher than that, wasn't it? Or is this a discounted rate because you're looking further into the future? I'm not quite sure I recognise and understand how we've arrived at those sort of figures.
So the first point is that the strategy talks about the methodology for including inflation within the funding mechanism and the valuation specifically, and then refers to the valuation figure included in the valuation. So the figure, whilst I will answer your question, the figure of 2.2% or whatever it is that's quoted is not inherently part of the policy and is not what we would debate in terms of the policy. But having said that, I will answer your question. No, it is not inflation as at the 31st of March last year or in the intervening period. What it is the actuary's assessment of inflation over the forward liabilities of the pension fund. So it's an assessment of liability of inflation, actually, technically speaking, at the point of the duration of the liabilities. So the duration of the liabilities is the weighted average date of the cash flows of the benefits. And the way the actuary, so the duration of our liabilities is somewhere around 20 years. And what the actuary does is look at the difference between the yield on government index linked gilts and government conventional gilts at the 20-year point of the curve, and that is deemed to be a market assessment of inflation over that period. So that's why it's,
so it's a longer term
so it's
view.
a number that doesn't feel in any way, shape or form related to inflation as we've experienced it over the last 15 months.
So it's a longer term view, and effectively we're pricing in the longer term trend of where inflation should be over the next 20 years. Is that fair?
Yes, and effectively, I think what the market is saying is it actually does believe that the Bank of England is going to achieve its inflation target of 2% in the long term. There is some technicalities there because the Bank of England's target is actually CPI, whereas this specifically refers to RPI, but post 20, I can't remember if it's 2028 or 2030, the two will actually be synchronized and will actually be the same thing. So in the context of this calculation, they do sort of merge. And that's a lovely technical question. I hope everyone's enjoyed that.
Thank you.
Okay, thank you, Mike. Peter.
Thank you, Chairman. My points relate to the sort of readability more than other matters. Page 85 and 86 of the agenda, pages 11 and 12 of the report. You're bringing in the section which is dealing with McLeod, and the authoring of this was clearly done around the time of the actuary's report, and some of the tenses need to change to reflect the fact that time has passed. What was future is now past. And the other matter, I think it's, yes, top of page 12, you have a hyperlink which works fine on some electronic devices and not on others. I strongly prefer when authoring that if there is I like the idea of putting hyperlinks into documents. However, I will put from preference a World Wide Web URL down so that it works on all devices, so that when you get a printed copy, go and type that in longhand and get to where you need to be referred to. Here doesn't work in print. But other than that, you know, I could read it. It was just I was having to think out the tenses.
Unfortunately, funny enough, it's not a document that creates itself in an instant. So that it's actually drafted by the actuary, not me. I don't write this typically. They drafted it. It's probably the last week of sort of mid-March, because this has already been considered by the pensions board at their April meeting. I'll have a think about tenses. I'll do my best.
Okay, I'm not seeing any other hands. No, I'm not seeing any other hands, so we'll move on to agenda item 11 then, please.
Is the committee happy then for me to go
Yes.
to consultation with the employers with the document as subject to adjustment of hyperlink and possible tenses?
Yes, subject to those criteria. Yes, we are happy. I can see that. Yep, there's no dissent from anybody in the room or online. So yes, we are happy with that. Thank you.
Thank you.
Now we'll move on to item 11.
Well, no, we've still got two other items here.
Sorry.
I just need to remind myself of what they are. So the next one is the Pension Fund Committee Terms of Reference, as alluded to by Councillor Sieve earlier, which is Annex 2. This is sort of a formal wrap-up. So these were considered by the Pensions Committee 9 months ago, I believe, in September or December. And we've had a couple of conversations as we've refreshed them going into unitary. But as a matter of good practice, now they've been formally adopted by the by Somerset Council as part of Somerset Council's constitution. I thought it good practice that actually you formally adopted them yourselves.
Yes, I think that's right. So I'm going to make a proposal from the chair that we do that. Seconded by Peter, and all those in favour? Okay, that's everyone in favour, so that was unanimous. Thank you.
Thank you.
Okay.
I will then move on to the committee scheme of delegation, which from my point of view, I think is an essential document as codifying some of the issues Councillor Sieve was referring to earlier. But it's actually quite rare. I'm not aware of any other local government pension scheme that actually has one, which I find astounding. But I haven't made many amendments to it. As noted in the report, we do seek certain exemptions from contract standing orders to note the specific circumstances of the pension fund. As contract standing orders have been rewritten and actually called something else now, they contract regulations or rules or something. I needed to make sure that they correctly aligned, that the references to paragraph numbers in that document match up. The exemptions we seek are an exemption to the need to use purchase orders. For Somerset Council, purchase orders are an essential control because you have umpteen budget holders, and it's a sort of an essential way of controlling invoiced expenditure. For the pension fund, effectively, you have one budget holder in a technical sort of MSD signing off sense, which is me. We get about 40 invoices a year. Typically, I sign off them all. So the need to coordinate different budgets and be aware of how that spend, not there. So it's just a control and a faff that we just don't need, frankly. So that's why we don't have it for the pension fund. And typically I commission pretty much all of that, the things that end with those invoices as well. So it's not as though I'm sort of remote from the start of the process. I'm the commissioner, the user, and I pay the invoice. And then the other change that we typically seek to have from the main council's rules is the sign-off procedure for new expenditure within the council, ultimately for spend above a given level goes to executive. But seeing as the pensions committee expressly doesn't report to executive, it would be highly inappropriate that they are sought to sign off our expenditure. Right. So in that sense, it goes to Jason as the Section 151 officer. I mean, invoiced expenditure is actually, and procured expenditure, is a relatively small part of the pension fund's overall outgoing. Largely, the expenditure basically comes down to what Devon charge us for Peninsula Pensions, what Brunel charge us, what the council itself charges the pension fund, and our IT, auditors and actuary. All of that is listed in the accounts, and I'm quite happy to have a debate about it, but it's not avoidable, largely. I mean, there are a few things that are avoidable if we really wanted to, but they are of real de minimis size, and I believe they are reasonable still. So that's where we are with that. I'm quite happy to have a discussion about any elements of the scheme delegation, any of the points that you want to sort of raise in the terms of the balance between committee and what officers do. But that's where we are.
Okay, questions? I can't see anybody online. Anybody in the room got a question on this? No, I didn't think so. Okay, Anton?
Can you formally adopt it, please?
I'd like to propose that we formally adopt it, seconded by John. Those in favour, please? Yeah, excellent. That's again unanimous.
Thank you. I'm quite happy to move on to the next item. Yeah, I'm just trying to find it.
Yeah, page 144.
Thank you.
Okay. I think it's 145, sorry.
I'm going to also slightly abuse, with your permission, Chair, the position to just give you a brief update on Brunel as well. because there has been sort of some ongoing things. You will have all seen my emails and the request for any opinions on the reserve matters and special reserve matters around the remuneration policy. We eventually found a way through that. It wasn't necessarily a way through that stacks up against logic, but such is the way of things sometimes in local government. So the remuneration policy has now been passed, and Brunel are now playing catch up slightly, but putting that in place, particularly with a view to how they recruit, but also in due course some elements to existing staff to hopefully persuade them to stay as well. So as a short-term part, that has been resolved. As a ongoing piece of work from that, we are going to re-look at all those matters that are listed as special reserve matters needing unanimity, all those matters referred to as reserve matters, which currently need 80% approval, and whether those approval rates should stay at 180%. That is slightly complicated because the Environment Agency is one of the funds within Brunel. The Environment Agency has a different legal framework to councils, whether they be unitary or county. And we are needing to take legal, specifically the Environment Agency is taking legal advice as to what it can and cannot allow for. There is a desire to change special reserve matters so they no longer require unanimity. The general feeling from this crisis is that unanimity doesn't really promote good governance and good decision making, because it allows any one of us to metaphorically stop it, put our heels in the ground, chuck our toys out of the pram, whatever metaphor you like, and not be cooperative, and therefore hold up possibly 9 other funds that want to move forward in a particular direction. So that is a piece of work. If committee want to go into detail about that, I'm quite happy to, but I would suggest probably not in a public forum. It is technical matters. I don't believe much of what is being proposed is anything this committee should be upset by. Formally, I will have to come back to you because it will be a special reserve matter to change it all. And I'm liaising with Jason as our shareholder rep, who physically signs it off on the technical matters as we go along. As I say, I'm quite happy to take questions and see where you want to go with it, but that was all I had to say on that before we get on to the matter raised.
Okay, just a word of caution before I bring people in. If we want to discuss this in detail, then we will have to go into closed session. So I just put that out there as a warning. If you want to go into absolute detail, then we will have to go into closed session. I'm quite happy to do. I have no problem with going into closed session, but we need to be aware.
I think that would be a matter really for what's put online, because I have no problem with those currently in the meeting remaining in the meeting for any closed business.
Likewise. So, but Peter, you have a point.
I think what I heard Anton reassuring me of was that were this to that this will come before us as a special reserve matter with a full explanation in due course, but that he doesn't feel that we should be concerned about the lack of any pre-brief. Am I correct?
So that because they're ongoing discussions, but the level at which I'm working currently is I think there's something like 14 areas where we currently have that are defined in the agreements as a special reserve matter, and another 15 that are reserve matters. and we are looking at each one of those with a discussion as to should it remain as a special reserve matter, a reserve matter, or be demoted from special reserve to reserve or removed. And there is a framework for that. And I've generally felt that the list was too long, too prescriptive and unnecessary generally from day one, and would have advised you as such along the way. And I see nothing that fundamentally, assuming committee is happy with the principle of special reserve matters no longer requiring unanimity, I don't see anything in the detail that should worry you. Because for me, the key ones are changes to the shareholders agreement, so the legal document, and approval of the annual budget. And those two will, I guarantee you, stay as special reserve matters. Yeah, there's other ones like Brunel can't enter into a contract over a certain size without it being a reserve matter. Really? I mean, we control the budget and it's a arm's length company. We shouldn't be, so I'm quite happy to circulate the document offline, but I don't think it's anything we need to get specifics. I suspect that my position, Jason's position, will be we're happy with what the consensus is proposing.
Just before I bring Peter in, I'm going to make a suggestion, and that is that we acknowledge the need to streamline this, and we await the paperwork from you to advise us in your view and Jason's view as to which we streamline and how quickly we streamline them.
I think this is a classic that when Brunel was first created 5 years ago, you're starting from scratch, and everyone was, you've got anxious. You had 10 funds, and if any one fund said, I want this as something that we have to vote over, it went in. And I think that 5 years of reality has both shown us the additional workload that some of those controls unnecessarily bring, but also have increased the level of trust all round.
That is always going to be the case. If not, we wouldn't be in the fund. So, Peter.
Yes, Chairman, I was just going to say, if it's helpful, my position, it would be that provided it's not a minority decision, a substantial majority would be perfectly appropriate for a special reserve matter, because there will always be circumstances where there are some specific legal provisions. For example, a local act might be interfering with one of the bodies that would create a circumstance where it became difficult, but not difficult administratively to get unanimity, even if there was commonality of purpose. And similarly, you are hedging against a vested interest. So, a high percentage for me is adequate.
I think the proposal that's on the table at the moment is that special reserve matters will move to 75%. And we're conscious that currently we're 10 funds, but we're also conscious that particularly if the government moves forward with adjusting pooling in any way, that we might not be 10 going forward. So we're bearing that in mind. But the proposal is that special reserve matters would be 75% and reserve matters would be a simple majority.
Yeah, I think that's something that we can agree here and now today. I'm going to take that as a proposal from you, Peter, seconded by myself. Can I see those in favour of allowing Anton to continue that? Yeah, that's unanimous again. So
Thank you.
Now, Mike, you had a question.
I was just going to support the principle of streamlining the decision making. I think it's perfectly reasonable, having been involved in my professional life with tripartite and multipartite arrangements with unanimity agreements involved. It's very, very complicated. It can slow down the decision making markedly. So I think it's an eminently sensible gesture built up from years of trust and collaboration. So I'm very happy.
Okay, excellent. I can't see any other hands up on that, so.
So coming back to the item as raised in the paper, one of the streams of governance, and actually the overall makeup of the governance, is probably going to be reviewed as well post the review that, because we do have quite a lot of touch points with Brunel, and we need to make sure that all of them are valuable to us and add value. But currently we have the Brunel Oversight Board. This is a non-decision making group that meets typically quarterly of specifically Pensions Committee members, to allow them direct access to Brunel, to ask questions and to report directly back to committees, as opposed to me doing it as well. So it is a additional layer on the top of what officers do. Sarah was our representative. So on the basis she's coming off Pensions Committee, we need a new volunteer.
It was a question first, which is have we replaced the union representation seat?
We have asked the unions. I have specifically via Chris Squire, who is the HR and OD lead officer for the council. I asked him for some contacts with the unions. He is duly provided. I have seen email from him specifically referring them to the email I sent him asking for a representative. I could tell you the exact date that was if you want, but suffice to say that I've had no response yet. It's one of the things in my in tray to chase. So the order is currently that is a place for a Unison. So we have only contacted Unison. If I continue to get nothing out of Unison, I will then open it up to the other unions. If I then get nothing out of the other unions, I will find some other way to get a member's representative on the committee. It would be disappointing if the unions do not engage or do not provide. It's particularly disappointing that they don't even acknowledge the email and give me a timescale, but that is where we are.
Chairman, I'm reluctant to use a potential union delegate because I think it's entirely appropriate that the union membership should have a direct line of reporting as well as the committee. However, I would be willing to be considered for that if as I work in Bristol, it would be rather more convenient for me to attend meetings at their headquarters.
So we were the only fund where a member's representative was our Bob representative, but members' representatives get to attending but not membership, but decide on the basis it's not a voting body. I've never quite worked out what the difference is. Places on Bob. So as well as the 10 overall, there is also an additional 2 representatives that are reserved for union member representation. So that shouldn't be seen as an impediment.
Offline, we're going to have to look at how we engage with the unions a little more forcefully to try and resolve this, because I also believe that it should be somebody from the unions.
Well,
I think it's appropriate.
Well, we need I don't think it's a particular issue one way or the other with the Brunel Oversight Board. Sorry, I shouldn't refer to it as Bob, but we do always. It's absolutely necessary we have a members' representative on this committee.
I agree. Okay.
Chairman, can I suggest if there were a meeting before, if it was agreeable to the committee and there was a meeting before the next meeting of this committee, then I would be willing to attend that capacity. I would step aside if there were a union rep who was interested, because I think it's a matter of principle for me. Pension schemes should be owned by their members, really.
Can I suggest that then that we appoint you as our Bob rep, and then we deal with whether we pass it on to someone else as and when we have someone in the room to have that discussion with.
Okay, to formalise this, I think I'm going to propose that we appoint Peter Seeb as our representative until such time as we know where we are. Can I see a seconder for that? Second, thank
Can I
you, John.
just make a comment? Can we make it absolutely clear that this is just an interim position and I preferred is a junior rep?
I don't think there's any problem with it being seen by everybody as an interim position, John.
Yeah.
I think
No, I wouldn't like
exactly
to think
what
it
we're
would be
doing. I think that's
overstepping.
precisely what we're doing. Okay, can I see those in favour of appointing Peter in that position, please? Thank you. That's unanimous. Oh, yeah, you are allowed to vote for yourself, Peter. You are allowed to vote for yourself. Okay, right, thank you. That was unanimous. Thank you very much.
And then there's a verbal update on knowledge and skills. I think it's fair to say that this is one of the areas where between the need to wait for the new membership of the committee post-unitary to form, so adding councillors Dunk, Fothergill and Hewitt to this committee. Fortunately, two of them aren't with us today. And sort of work through just getting them to base camp before we all take on Everest, and other work issues and capacity. I haven't really addressed this much in the interim since the last meeting, but I haven't forgotten it. We will, and yeah, we need to be better at it going forward. So I will keep on about it. I'm happy to take any questions.
I think the only question is how long do you think it will take?
I'd like to think that I'll get more space to do stuff in the autumn, but
shall we aim for September?
Well, so where we are with this is that I will collate the results as per, and then present those to you and start talking about what areas both you wish to prioritise and worry me most from the results we have as for training, and then we'll sort of move from there.
Can we bring that to the September meeting? Do you think you will have time to?
I would hope so.
Okay, well, we aim then for the September meeting for that discussion, and we can all contribute to that to see where it is we feel we are strongest and weakest and where we feel we need the help. Okay, so that's good. So we're now on agenda item 14, which is any other urgent items of business. I've not been notified of any, so unless there's anything last minute, Anton, from yourself or from anybody in the room?
No.
Nobody online either? In that case, I'd like to thank everybody for their attendance this morning, and do have a pleasant weekend. I look forward to seeing you all probably next week. Thank you very much for your attendance. Good morning, everyone. We've done it in just under 2 hours, which is good.